decide to lift interest rates again, another decision that could affect you if you're paying off a mortgage. Peter White is the Managing Director of the Finance Brokers Association of Australia. Hello, Peter.
Hi there. Thanks for having us on this afternoon.
Peter, how was it? Was it a sort of obvious decision today that the Reserve was going to lift it, or more line ball?
I think that the actual would it happen was pretty much done. Should it happen is a very different question, and it shouldn't have happened. And I think the RBA is still not understanding what mum and dads and people generally go through, in that there just hasn't been enough pause to actually take full note and impact of what past impacts or past increases have actually had on people's lives. And they should have waited a couple of months before even looking at doing this again. And unfortunately, they have. They're in a world of their own, and I think it's a very bad decision, personally.
That decision today was to lift the interest rates by 25 basis points to 4.1%. Well, that's the cash rate. What's that realistically going to see some people paying on their interest rates now?
Yeah, so it'll depend on what people take up as a fixed or variable rate, but you could be paying upwards of 6.25% as a variable rate. Some fixed rates might be around that sort of money or a bit lower in the high fives, but generally you're going to be in that high fives, early six bracket, and probably more like 6.25%, and you may even find some rates that are a lot higher than that as well. So it's an important piece now to really shop around. But the thing that now concerns me, this is where APRA needs to step up and show some strength and authority in reducing the buffer rate. So if you're already in the system, so it's not about existing borrowers, if you want to try and get a better deal, it's now even more difficult because there's a 3% servicing buffer put on top of whatever on the top of the variable rate.
What does that mean, Peter? For those
well, if you're trying to get a loan, if you're trying to get a loan, when the lender does their servicing calculations to work out can you afford this, it won't be the 6.25%, 6.5% interest rate that you're likely to pay. It'll be 3% more than that. So it'll be 9.25%, 9.5%. Right?
Because what they're factoring in future increases, are they? And your ability to play that.
Correct. And I've actually been on public record saying, well, wait a second, are you telegraphing us that that's where rates are going to go to? And they most seriously are not. And that servicing buffer rate should be reduced down to 0.5% to 1% possibly in the current marketplaces, because people will become prisoners with their own lender. And if their lender decides to up their interest rates, and what you've got to remember is the advertised rate, which says, hey, look, we're wonderful people, we've got a good interest rate. What they're not saying to you, and we've asked for transparency of this for government, is that their existing borrowers are still paying 0.5% more, right? So people get trapped in their situation because of this, and they get disadvantaged. It's almost like a loyalty tax for staying with their existing lender. You're going to pay more than what they're offering new people to come into their lending trip.
Peter, didn't a lot of people get into this trouble though because they didn't factor in rising interest rates? They, they saw that they could get more money or more borrowings that would allow them a bigger home, and suddenly there was no wriggle room. So,
in part, yes. If we rewound to about 3 years ago, 2-3 years ago, when interest rates were really cheap, you add the 3% buffer onto that, and you're still only paying, a 4% interest rate somewhere. You would be paying a retail interest rate around 3%, and your servicing would have been based on 6 to 7%. 9% is just out of the market. No, we're not going back to those draconian days of interest rates that high. So APRA, as the regulator of all the banks, they are the ones who say to the banks, you must do 3%. That needs to be reassessed in line with the market as it is today. And it doesn't mean that was wrong in the past, but it is certainly wrong today. And when it was assessed in the past, if you remember, we're down to what was about 0.5% cash rate. Nobody expected or saw this coming, not even the governor of the Reserve Bank. So Mum and Dad are never going to see it coming. I've been in this industry 45 years. I didn't see it coming down this way, except we knew it would always go up. Because in a cyclical market over decades, you can see the cash rates are a lot higher than what we normally have, and same with what's happening overseas. But this is where we need some compassion, some smarts play out in a regulatory and government front to say, Okay, well, we kind of own this now, but there are measures that can be had to make it better for people trying to refinance their loans than what it currently sits at the moment.
Jim on the text line says, my variable rate is currently 7.68% prior to today's hike. So that's possibly going to go up even more. I hear you groaning there, Peter.
Yeah. I'm sorry, this isn't meant to be a promotion, but go see your broker and get that sorted out. That rate is ridiculously high. There are so many better deals in the marketplace than that. And that's somebody who's probably been with their lender for a while, and the lender's gone up it and up it and up it and up it behind their back. So this is the existing borrower rate, what we call the back book in the industry, versus what they're offering to new people to come and join them.
Now, we're more than a year into these repeated interest rate rises with the potential of a few more to come yet. For those who haven't had to do anything up until now, or haven't had to do much up until now, who've been able to cope with that, a lot more are going to start to feel the squeeze now. What can you recommend, Peter? Because from what you're saying, even your ability to move within the mortgage market might be getting tight.
Yeah, so there's a few things people can do. And I kind of hope this might be the last for the year, by the way. It may not be. I think we've now got a better than average chance that there won't be any more this year. But that doesn't mean there won't be. So it all depends what happens with inflation around the world. But coming back to what people can do, first thing to do is to go talk to your lender. Whoever your lender is at the moment, if you think you're going to be falling into financial hardship or are having financial hardship, go speak to the lender. They have these days very specialised hardship provisioning departments within the banks to look after you in these circumstances. If you feel the bank isn't doing the right thing by you, you can lodge a complaint with the industry ombudsman. And you can do that, and they also intercede and try and sort things out as well. Refinancing becomes another option, but of course this buffer rate thing makes it really hard. But there are many
and also if you're in a market where your equity is dropping because the price of your house is dropping, you may not be in the same market to attract as favourable an interest rate, right?
Exactly.
Or deal.
It could be problematic. Well, it could be problematic in doing it, and that's where you need professional guidance into what the options are, because there are so many options. Because we talk about the banks and what APRA is doing. Of course, we have an enormous suite in our industry of what we call non-banks, who are not governed by APRA and don't have necessarily 3% buffer rate. So there are options there outside of the general thought process of go to the bank to get my home loan. And you need to explore those options, especially now. So critically important to look at what the non-bank options are. It doesn't mean it's a higher interest rate. It's just their funding structures are different, so they don't have the same issues and challenges the bank would do, and they're not governed by APRA. They have a much more open, commercial and fair mindset.
Yeah. Peter White is Managing Director of the Finance Brokers Association of Australia. We're talking with him today, 15 minutes after the Reserve Bank announced it's lifting rates again this month by 25 basis points to 4.1%. The cash rate now stands. Obviously, your mortgage rate may be different to that, either on a fixed or a variable. You were groaning at the person who said their rate was 7.68%. I've got someone who says I can do better than that. I'm on 7.84. So you'd be advising both of those to check out whether they can get a better deal, Peter.
Yeah, go research the market. There are independent websites that are of course, are great websites that are they're not pushing product on you, but they are just a comparison side of interest rates in the marketplace. And there's things like finder.com.au and Canex and so on. There are groups where you can look at the different rates in the marketplace too for yourself.
I know we've talked about this before, but every time there is an interest rate rise, I guess the pendulum sometimes shifts. What's your attitude to fixed and variable? Now, I'm a fairly naive financial person, but I was always of the view that I wanted to stay on variable because I felt that the banks were never going to do me any favours. If they are offering a fixed rate, it had to be better for them than me.
You're right.
Because I was cynical. So I always said, I'm going to stick with a variable rate.
I think the old anecdote, nothing's free.
Yeah, exactly. Exactly. But I'm fairly naive on these things, and a lot of people swear by the fixed rate. So where do you sit on that side of things at the moment, Peter?
Sure. It comes down to it being a very personal decision because, both can be attractive for all the right reasons. But what you've got to look at is what is your personal circumstances. So if you've got no plans to do any renovations or to sell, you just want to pay your mortgage off for the next 2, 3, 4 years and not think about doing anything, then maybe a fixed rate's right for you. If you want to do something to your property, and you may need more money to do that, you want to stick to the variable because there's no break fees, there's no costs that are involved in doing that. Or alternatively, you can go part fixed, part variable. So there's a whole host of options there. But one thing that's tricky in today's market is it's been predicted by economists that, yes, we are going through this period of time where interest rates are rising. They said, well, hopefully this is the last, doesn't guarantee it, but everyone's still in the position, once inflation's under control and it starts coming down, next year interest rates will come down. So if you're on a fixed rate now for, say, 2 years, you're probably going to be disadvantaged as you go into next year. But it's a mathematical exercise to say, well, what will the payments be through the fixed rate? What will it be through a hypothetical variable rate? And where is the point where I'm actually financially better off? Again, this is why the financial advice piece and getting some guidance is really important, because it gets a bit complicated. It is personal, but there's a whole lot of things that are going to come up that, regardless of once inflation gets under control, rates will start to come back a bit. So not a straightforward answer.
No,
and
it's
the
not.
banks are not doing it not to make a profit. If you look at the bank's profitability lines, they do all this to make sure they make money. So you've got to play your decisions as best you can that suits you.
Yeah. Now, we're talking with Peter White. Now, he's from the Finance Brokers Association of Australia. You're not an economist, Peter, but I tell you what, some people are making comments about the questionable economics of this decision in their view. Angela, you say it's a silly question, but if people are paying out more for their mortgage, I would have thought that they would have less money to spend. How on earth can that help the economy? Kim, you say, what about the 20% increase in energy prices? Don't they think that'll suck a heap of money out of the economy? And you go on, Peter.
I was going to say, these are all very valid questions in that it points back to what we said earlier. The Reserve Bank should have waited. They should not have made a decision now, because these impacts in increasing energy prices, I know what my wife always says to me. She comes down and says, look, see this bag here? I've got one bag. It cost me $100. It used to cost me $50. Yeah. And so going, wow, the price is just rocketing. And the Reserve Bank isn't sitting back appropriately with a measured time to understand what the true impact is throughout the marketplace. Because no one gets a chance to catch their breath and go, okay, can I manage this or can't I? Yeah, it's just snap, 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 and the rate changes and changes and changes. So we know through some research we just did that rubber band is almost but stretched to its limit.
Yeah, look, I think a lot of people can tell that without the research. They're feeling it. Yeah. Peter, on the text line, you are from the Finance Brokers Association. So a couple of questions, about people who are looking at their options, wondering about these things. A couple of people say, look, I don't seem to be able to refinance my home. If you change jobs or work circumstances change, it's difficult to refinance. So again, you're being limited on that front. Another, and I'm not sure why this is the case, but you might be able to explain it. It says, I don't seem to be able to refinance my home loan because my remaining debt is only, in inverted commas, $130,000. The current rate is 7.67%. Any advice? Asks this person.
So there are so many variables, it's hard to pinpoint any one particular answer, except to say there are many options out there. And if you don't engage someone who knows what all those options are, then you'll get a limited response back. And say the dollar amount of $130,000 is irrelevant. If you're talking $10,000 or $20,000, I'd probably say, yeah, you've got some challenges there because that becomes very small in home loan world. But at $130,000, you should be able to refinance that on a good rate. The thing that generally impacts your interest rate is the loan to valuation ratio. So how much your loan is against the value of your property. That is generally the marker that winds up in what they call a higher risk bracket. If you're up around, say, 90% lend, that can attract a higher rate at times. It depends on the lender. But as I said before, there are so many non-banks out there that aren't tarred with this brush. It's so critical in today's market that people look around at all the options and don't just think a bank's going to save you. because they're probably not.
Yeah. Getting more texts from people who say if you owe less than $100,000, still a sizable amount of money, but if you owe less than that, no banks really want to talk to you.
Yeah, time to talk beyond the banks. The banks should. They don't. Their lower limits are down around, from my last recollections, around the $20,000, maybe $50,000. But there are so many options in the marketplace. We just got to get out. It's hard because so used to get out of our thinking that the banks are the answer. They're just not. And there are plenty of options out there. But there are some instances where we'll find a bucket that just can't help. So if you bought a property at the peak of the property price marketplace over the last couple of years and borrowed at a really cheap interest rate and maximised your debt, you could be in a few difficulties coming up.
All right.
Because the property may not be valued what it is, and the chance to refinance is going to be slim because the way interest rates have gone through the roof and that damn servicing buffer on top of it.
All right. Kerry's given us a ring from Kadina. Hi, Kerry.
Yeah. How you going?
Good.
What I wanted to know was if the bank comes and takes my house off me because I can't pay for it, do they have to auction it off and get the best price they can, or can they just sell it on the open market?
Like a fire sale?
Yeah. Well,
so I'm not a stock expert, and there are some very good agri lenders in the marketplace, but the principle of a bank or a lender taking something and selling it, they will get whatever they think is reasonable, and that could be very unreasonable.
Yeah.
It's the same whether it's property, it could be the same with cattle. They are not bound to get the absolute best price. They should be achieving a very good price, so they shouldn't just be accepting something that's ridiculously low. There are some rules that sit around that, some laws, but it doesn't mean you're going to get top dollar.
Yeah. Kerry, thanks for your call. Sean's in Clare. Hi, Sean.
Yes, hi. Yeah, regards to that one, the banks will just grab what they can for paying off the loan and too bad about what's left over, which is nothing. And was it Peter Lowe?
Yeah, I do.
The guy, yeah, who's raising the interest rates. Well, he's leaving, so he doesn't care, and he's had stated that he'll do what he has to do, and he'll just keep pumping it up. And until he leaves.
I think it's Philip Lowe, but yeah.
Philip Lowe,
okay, Sean, thanks for making your comment. And Kim, hello to you.
How you going?
Yeah, good.
My question is, when you start paying a home loan, you pay a pittance of principal and nearly all interest. And by the other end of the loan, it's nearly all principal and hardly any interest. So if you refinance and you're, say, halfway through, won't you lose that advantage?
That's a good question, Kim.
Yeah, it is an excellent question. So this is what they call amortization. So that's the structure of your loan repayment and its components of interest versus principal debt. And what you said is exactly correct. So that for generally the first half period of the loan and not less than the first 5 years of the loan, depending on the loan term, you'll almost pay nothing off the principal of the debt of your loan. And when you refinance it, yes, you go into reset mode again. So this is where there's some little tricks in the industry. So interest is calculated daily, but debited to your loan account monthly. So if you pay extra every week, you actually shortcut that interest calculation all the time, and you'll pay your loan off quicker.
So are you saying more or just more frequently?
No, it can be the same. So if you take your monthly payment and divide it by 4 and pay it weekly, you will actually, over time, pay your loan off quicker.
Than paying one payment a month?
Yeah, one payment a month.
Oh, that's interesting.
Because
so you don't have to pay. You don't have to pay any more. You just have to pay it more frequently across the month.
Correct. And if you want to play even smarter, you go to, if you say you divide it by 4 and you do that for 12 months, that's only 48 weeks in the year. There's actually 52. So if you divide it and make your payments more quick, a little bit more quicker than that, so 4.33 weeks to the month, again, it pays off quicker. So it stops the interest calculation. They're only little bits, but over time they make quite a significant difference. And so does lump sum payment. So, if you've got to spare $500 or more, put in your loan account, it will make a huge difference because when you do a lump sum, it comes straight off the principal debt, your loan amount. there's no interest snuck out of that.
But just to reiterate, even if you don't pay more overall, as long as you pay it more frequently during the course of the month, what you're obliged to pay, you will over time pay off more of your principal than your interest.
Yep. 100%. And the more you pay, the better the impact of that. So don't get me wrong. That's sort of like the minimum. You know, pay your monthly payment on a weekly basis. You know, like the 1/4 of it each week. That's sort of your minimum entry point for an advantage. But it's still an advantage. But the more you pay in doing that, and so hypothetically, if you're paying $400 a month, if you could afford to pay $420 a month, but pay that every week, so 1/4 of that each week, you'll pay your loan off even quicker again.
Peter White, it's been worthwhile talking with you. Thank you so much for your time today. Managing Director of the Finance Brokers Association of Australia. You're listening to ABC Radio Adelaide, South Australia and Broken Hill. And if you have just joined us,